When you spread bet on individual company shares, you need to know a little about the type of shares which investors categorise different companies into. By this, we do not mean ordinary or preference shares, but groupings which categorise the potential performance of a share. When considering a company's share, first categorise what type it is. Then consider how it is likely to perform before finally making a decision to bet on it. Here are the main types of shares. High-yielding shares. High-yielding shares are those shares which offer a high rate or return of dividend. For those buying shares, they are less risky than growth stocks. They are not expected to grow so quickly, so any setbacks will have less of an impact on share prices. This advantage is, however, turned into a disadvantage for those betting on individual share prices. That's because any fluctuation in the price is usually minor and tendency to buck the trend modest. Growth stocks. With growth stocks, investors are looking for an upward movement in the share price rather than a high dividend yield. Growth companies are usually those in expanding market sectors. In addition, they will benefit from good management, have higher than average profits, and be at a stage where they want to plough profits back into the expanding company. You can therefore expect that the dividend yield will be lower and the price/earnings ratio will be higher. Growth stocks are ideal for financial betting. They hold the potential to rise in price dramatically, or alternatively, crash in price spectacularly if the anticipated growth fails to materialise. So, it is possible to make a great deal of money if you predict all this accurately. However, to do this successfully, you will need to study the company carefully and follow its progress in detail. Recovery stocks. These are the shares of companies which have been going through a difficult path. They may be firms which have been successful in the past, but which have seen a drop in profits because the general market is poor. Or they may be shares which have not met investors' expectations, or which are falling. If you bet on these shares when they have hit the bottom of the cycle, or at the end of the recession, you could bet on them making a large and unexpected gain when they start to move up again. Blue chip stocks. The term blue chip comes from the stakes in poker. It refers to shares which are often issued by big companies and household names. These companies are usually valued at a minimum of £5 billion. They often form the basis of pension fund and insurance company portfolios. They are often, but not necessarily, in the FTSE 100 list. The chief advantage is that it's easy to track the performance and prospects of blue chip shares because there's a lot written about them in the press. The disadvantage is that changes in the share prices are gradual. The secret of making a great deal of money by betting on blue chip shares is to spot or anticipate something coming up which could unexpectedly rise or lower the share price.